listening to the Economics and Country Risk podcast from S&P Global Market Intelligence. In each episode, our experts will provide you with the where, how, and when to make decisions that transform your business.
Hello, and a warm welcome to our latest PMI-based podcast from S&P Global Market Intelligence. I'm Paul Smith, a director in the team that produces PMI figures for over 40 countries around the world. Today I'm joined by Andrew Harker, a fellow PMI-based economist, and I'm also delighted to invite onto the podcast Tia Foray. Now, Tia is the head of sub-Saharan Africa Insights and Analysis at S&P Global Market Intelligence and is here to help Andrew and I unpack recent economic developments in the region. But what is especially exciting for us today is that Tia is an active consumer of our survey data, using the PMIs each month to understand how economic trends across several countries in sub-Saharan Africa are evolving. And through that lens, I'm hoping that Tia will be able to offer us some insights into why the PMIs are so valuable to her and her team. So with that in mind, Tia, welcome to our podcast. It's great to have you here. And maybe I could just kick us off by asking you to outline one or two key features of the PMI data that make it so useful for you and your work.
Thank you very much for the invite, Paul. And hello, everyone. Well, Paul, indeed, the biggest benefit that the PMIs hold for me is the ability of the PMIs to provide up-to-date information on the most recent macroeconomic developments and trends in the sub-Saharan African region. There's very few countries in sub-Saharan Africa, with the exception maybe of South Africa, that has any leading indicators available. And the PMIs, to me, provide up-to-date information on input prices, output prices, what's happening to output levels, what's the stance on employment and wage agreements, and what's happening to wage costs. And also very beneficial is the sectoral PMIs that's released on a monthly basis, which gives me an indication of what's happening in the agricultural sector, manufacturing sector, and particularly the services sector. We're also very excited to inform our clients that we use the PMI in our nowcasting tool for the South Africa real GDP. It's, of course, one of several tools that we use. It's a package of tools that we use, but the PMI is also used in this regard. So widely used in our team to give us a very up-to-date perspective of what's happening on the continent on a macroeconomic level, indicators that we do not have available otherwise.
And that's monthly, of course, isn't it, really? So as we know, this data gets released within a few days at the end of the month. So it's really, really helping you to fill that gap in the market, really. And I guess things like just having that consistent methodology, right, that helps you as well, being able to compare how different areas of the region are performing.
Absolutely. Rightly so, Paul. I think maybe we'll talk a little bit later about, for instance, Nigeria, where we saw some key policy changes being implemented in the Nigerian economy. And the PMIs was the only indicator which provided us up-to-date monthly information on what's the implications of these policy measures being implemented. So very, very helpful.
I'd like to think as well, you find it quite a very accurate indicator, right? So you mentioned Nigeria there, which we'll come on to in a little while, but it does have a good accurate indication, doesn't it, of where things like GDP and prices are heading.
Like I mentioned, Paul, we use it in our nowcasting model, and we have very, very good results. And I think one of the key reasons this is so helpful is that we have the services sector in there as well. So for some countries, you have manufacturing information available, retail sales, specifically for South Africa. But for the PMIs, we have the services sector in there as well, which really enables you to make a very realistic forecast on what's happening in that particular country, in the particular region. And it's important because services in many instances are the biggest component to the overall GDP in sub-Saharan Africa. So to have a comparative, reliable indication of what's happening on the services side is essential to assess what's the outlook for the region and for particular economies. So extremely, extremely valuable in that regard.
Especially when GDP data can be quite slowly released. And that services data is something that's to be honest, quite common across the world, really. And it's one of the core reasons why we started the PMI surveys, was really to fill that gap in the market. So thank you, Tia. That was fantastic. Hopefully it gives listeners a sense of why the PMI data is so useful and valuable to economists like yourself. Some things that you mentioned there, the timeliness, the accuracy, the coverage, that is a common feature across all of our surveys. Whether you're looking at South America or the Eurozone, across the Asian continent, or of course, in this instance, sub-Saharan Africa, the PMIs can really help understand how economies are performing. So I think that's hopefully set quite a nice scene to maybe explore with both Tia and Andrew some of the latest developments in our PMI for sub-Saharan Africa. Discuss a little bit of theory there, haven't we? This is now putting some of that into action and practice. We've got data up to April, so very timely. Can I come to you, Andrew, first, really? And Tia said we were going to talk about Nigeria, and I think that's a good place to start, where it's fair to say we've seen some gyrations in the data in recent months, haven't we?
Yeah, we certainly have, Paul. So Tia alluded to policy implementation, and essentially what we've had is a cash crisis in Nigeria. Essentially what happened was that the authorities wanted to try and replace the existing notes in circulation with some new ones. And so the main issue they had was, unfortunately, they didn't provide enough of the new notes to replace the ones that were being put out of action. And so that literally meant that people just didn't have access to the cash, didn't have the money in their pockets to be able to pay for things. And that's caused quite a severe impact on business activity in the country. So what we saw in our PMI data, which is sponsored by Stanbic IBTC Bank in Nigeria, was that in February and March in particular, we saw severe declines in both output and new orders. As I say, just customers were not able to pay for goods and services, and so that caused a massive reduction in business activity. It's fair to say that things have started to improve, so there is a bit of a recovery underway. I think access to cash has started to get better, and that's what we saw really come through in April. Companies talking about signs that business conditions are normalizing, and we actually saw returns to growth of output and new orders in April. The conditions are starting to ease, but certainly at least a couple of months where there was a real severe impact on the economy from this cash crisis.
It led to a bit of a stop in the PMI numbers, really, and key variables. How about something like prices? How has the cash crisis affected some of the price indices that we capture in the surveys?
Yeah, it's an interesting one, really. What we saw from the price indices is what the crisis had a downwards impact. The situation was that people just couldn't pay for things, and so you had companies looking to maybe offer discounts where they could to try and capture whatever demand was out there and respond to that lack of money in circulation. So it did initially have a bit of a downward impact on inflationary pressures.
My initial thought would have been it would have been inflationary, but
Yeah.
Fascinating to see.
Yeah, I think it's just people just didn't have the cash, so yeah, companies had a choice to make, I suppose. They could either lower their prices to try and get some sales in, and that's what they opted to do in some cases.
Yeah. Just turning to yourself, Tia, with this, how has this kind of cash crisis impacted your reading for Nigerian economic output in the first quarter of the year?
I agree with Andrew. What was the most surprising to me was the slowdown or the fall in the PMI readings, your input prices over this cash period. But I also think it gave a very strong indication of what happened to domestic demand, and it actually forced S&P Global Market Intelligence to have a relook at Nigeria's first quarter GDP growth numbers. And we revised it down a few ticks. So we do expect GDP growth in Nigeria to be 2.9% now, which is marginally lower than the 3% we have seen before this cash crisis. What is concerning is during April, we've seen a bounce back in input prices, the PMI input prices. So it's kind of a normalization there. And Nigeria's interest rate since the end of 2022 has already increased by 600 basis points, and inflation continues to be sticky. So this rebound in input price pressures is concerning for an economy that's got double-digit inflation at 22%. So something we watch very, very closely, but it has been an indicator where we looked at to see if our growth projections for this year still make sense.
You just said there that the central bank 600 plus basis points already. Will they look to continue to tighten, do you think? I guess it is dependent on that inflation outlook, right?
Absolutely. There's so many things at play in the Nigerian economy in the next few months with the presidential elections out of the way. There's the likelihood that Nigeria will have to start lowering its fuel subsidies, which can be a little bit inflationary. There's the prospects of sticky food inflation on the back of severe floods we've seen in previous months, which can have an impact on food inflation. And then this bounce back in the PMI input prices, have to see what the output prices looks like in coming months on the PMI side. So, looking at all of this, and I must add the prospects of some more currency depreciation could actually means that the central bank will increase interest rates by a further 50 basis points in our view. We're very close to the upper end of the tightening cycle in our view, but we still think there's some possibility of further increases over the short term.
Hopefully the PMIs are going to help navigate through that tricky situation I think that the central bank clearly finds itself in at the moment. We're going to head down to South Africa now, and from what I can gather, there's multiple challenges facing the South African economy. I think load shedding is particularly pertinent at the moment. It's something that we did cover a couple of episodes back on one of these podcasts, but for those who aren't familiar with the term, my understanding is, and please do Tia and Andrew jump in if I get this wrong, load shedding is really to do with kind of the deliberate shutdown of electrical power in the distribution system, really a way to prevent complete failure. It's a kind of restriction of supply, electricity being provided during specific hours, etc. Andrew, it'd be really good to hear how that's been affecting the PMIs in recent months.
Yeah, you're right, Paul. We did cover this a couple of episodes back, and unfortunately the situation hasn't got any better. If anything, it maybe has even got worse. I'm sure Tia knows all about it, being based in South Africa herself. So what we've seen in April is a further reduction in business activity, with the companies that are responding to the survey often linking that through to the load shedding program and uncertainty around power supply. So we've actually seen business activity fall for 7 of the past 8 months now. And in fact, if you look at the latest numbers, we actually had a rise in new orders in the private sector in South Africa. So there was some demand coming through, but companies were just unable to meet that demand due to the issues with the power supply. So what we've seen is that backlogs of work have risen because companies just aren't able to complete their orders that they're getting through, which is a shame for them. Some of the other impacts from the load shedding, it also affects material supply. Companies aren't able to get in the materials that they need as easily. And it also adds to cost pressures. What some of our companies are telling us is that they're looking to alternative energy sources to try and get more reliable flow of energy through. But often, of course, these alternatives are more expensive. And so they're adding to company cost burdens. And then that's again feeding through to the prices that they're charging for their products. So, yeah, multiple issues really coming from the load shedding affecting businesses and, again, holding the economy back, really.
It's a huge constraint, isn't it, on the South African economy and how it's performing. How are you reading the situation, Tia? Obviously, you're actually in South Africa, so you're really on the ground and facing yourself, I think, some of these load shedding challenges. What's your reading at the moment in the South African economy in terms of growth and other major macro kind of variables?
From a personal perspective, load shedding is really not fun, and it's really dampening the mood for all South Africans. It's really a drag on sentiment, I can assure you of that. But what's very difficult, and where the PMIs is going to help us a lot in coming months, is to what extent will businesses be forced to increase their output prices to compensate for these alternative energy sources. Like Andrew just mentioned, companies are looking at making plans to alleviate some of the shortages on the electricity side, but it's hugely expensive. And we have seen a drop in the South African rand in the past few days on the back of some political developments. The expectations or the hope were that interest rates would not rise as much during the next Monetary Policy Committee meeting at the end of May. However, with the rand weakening, and if you look at the PMI numbers on the output side, where PMI output prices continue to increase well above the 50 neutral level, you have to, like I said, start wondering how much of this is due to electricity supply pressures. And if I listen to Andrew, where you have material shortages and bottlenecks in the supply chain due to these electricity disruptions, it's very hard to see the central bank not taking a more aggressive stance and maybe hiking interest rates by 50 basis points by the end of this month instead of 25 basis points. So it's costing the economy a lot, these inefficiencies, the electricity bottlenecks. It's really putting a damper on our potential growth, which is now closer to 0%. And it really no possibility of the economy expanding a lot. So our growth forecast for this year is 0.5% expansion in real GDP. We do expect quarter-on-quarter growth for the first quarter of this year still to be in the positive territory, supported by PMI readings and a lot of other factors feeding into our nowcasting model. But things are really very, very problematic and, like the PMI shows, very difficult to manage.
We've done some work, haven't we, on the nowcasting in Q1, and we are looking at some marginal growth. Even if we avoid technical recession here, it doesn't necessarily mean that things are great. As you said, sentiment is struggling and the outlook seems quite challenging, to say the least, especially if this load shedding situation gets worse, right?
Absolutely. I totally agree. So it would be interesting to see what the PMI starts showing for the second quarter of this year. Then we will see increased load shedding over the winter months. It is part of our forecast and definitely will be difficult to maintain this positive quarter-on-quarter growth. But let's see what happens.
Yeah. I think official data is out in June, but for Q1 GDP. So we're highlighting again the value of PMIs. By then, we'll have 2 months of PMI data for the second quarter. So again, just highlighting that of timeliness in the PMI numbers. I guess if we could just take a regional view, really, and we've mentioned Nigeria and South Africa there. Andrew, could you confirm for us the number of countries that we cover in sub-Saharan Africa with our PMIs?
So we cover 7 economies in sub-Saharan Africa. In addition to Nigeria and South Africa that we've spoken about, we also cover Ghana, Kenya, Uganda, Mozambique and Zambia. And so 5 of those 7 are actually sponsored by Standard Bank in the local countries. So it's quite a long-standing relationship we've had with that bank to sponsor some of our surveys.
I'm sure listeners are very aware of our Eurozone PMI and that we do similar things for ASEAN and things like that. We can take that sub-Saharan African data, can't we, and give a snapshot PMI of all 7 countries, right?
Yes, we can weight them all together. So we look at which economies contribute most to the overall GDP, weight them all together that way. It gives us a sort of a sub-Saharan African aggregate that we can look at and see what's happening.
And what's the latest data showing for that aggregate number?
So the latest data has moved in a similar way to the Nigeria PMI, really. So back into growth territory in April, thanks to that recovery in Nigeria from the severe cash crisis issues that we spoke about earlier. Apart from Nigeria, we're also seeing growth in Uganda and Mozambique, and actually signs of recovery in Ghana. I think we mentioned Ghana again a few episodes back as an economy that was struggling, but there's been some signs of recovery in the PMI survey since then. So a bit of a mixed picture, some signs of growth, but again, weakness elsewhere. One of the places where there has been a bit of weakness I thought would be interesting to mention was Kenya. And that's somewhere where sort of the cost of living pressures have been quite severe and have led to sort of anti-government protests. And that really came through in the latest PMI survey as having dampened business activity. And that issue around cost of living, I think, is something that's been felt more widely, not just in sub-Saharan Africa, but elsewhere as well. It's something that we're aware of where we are, and much of the world, I think, is facing a similar pressure. And one thing I wanted to highlight from the sub-Saharan Africa numbers, if you look at the aggregate for the wages index, it's actually running at its highest since, I think it was back in 2014. So what we're seeing is those wage pressures really quite high at the moment. And what we get a lot from our companies, we're asking them about what's causing those wage pressures, is that they're coming back and saying that they're just trying to help their workers really with responding to the cost of living crisis, and so putting up wages for that reason. And that's led to wages rising at quite rapid rates, really, relatively to what we're used to seeing in the surveys. So again, that's linking back to what has been a bit of a theme of the episode, really, talking about like the stickiness of inflation, how much output prices are going to stay elevated and continue to rise sharply. And I guess that's going to feed through to that as well.
That classic thing of second round impacts there, isn't there, with that wage index? So that's definitely something that will be worth watching in the coming months. Just turning back to you, Tia, there seems to be a number of challenges at the moment across the region, this load shedding in South Africa and the cash challenges in Nigeria, and then the cost of living in general, really. I just wonder whether you have a longer term outlook for the region. What's your thoughts on that at the moment?
I must say, listening to what Andrew reported on the wage side, that's of course very concerning. And as you mentioned, Paul, the risk of inflation expectations becoming unraveled as these wage pressures increases is very concerning. And it also means that you probably will see interest rates bumped up a little bit more and then move sideways for the remainder of the year, but then really have to bring wage pressures under control before you can start thinking about lowering interest rates. And that is very problematic from a debt servicing perspective for sub-Saharan Africa, because some of these countries like Zambia, Ghana, which is covered by the PMI, really going through very difficult fiscal backdrops and very problematic debt servicing backdrops. These economies are struggling to service external debt and domestic debt increasingly as well. And if you think about a country like Nigeria, whose debt is also going to go up because central bank debt is now added to the public sector debt holdings, the higher interest rates backdrop is really problematic for these economies. And one thing that our clients should continue to monitor and really keep a close eye on, the wage information by the PMIs, how that directs interest rates and ultimately debt sustainability is crucial. And luckily we have monthly releases of this information, and something that I would most definitely track in coming months.
I think that's a fantastic way of bringing it all back around to the PMIs. Really fantastic insight, and it's been a really good and captivating session today, really bringing an extra layer of analysis onto our PMI discussion. I think we could probably go on for quite a long time, couldn't we? Again, my many thanks to you, Tia, for joining us today on our podcast. Also to you, Andrew, of course, for your regular and insightful contributions. All that's left to say is, as ever, please do keep up to date with all of our PMI data releases via the S&P Global website. And I think, and we hope, to be producing another PMI-based podcast later in the year. I think the next one is due in July.
Thank you for listening to the Economics and Country Risk podcast. Connect with us on LinkedIn and Twitter, and don't forget to subscribe to the podcast so you never miss an episode.